He called it a little glitch. That is the exact phrase Donald Trump used this week when asked about the economic chaos spreading across global markets. A little glitch. We had to take this detour. Oil above $120 per barrel, the highest since 2014. Recession odds on prediction markets nearly doubled in a single week. Ship transits through the world's most critical oil choke point down 95%. Global stocks losing trillions. The Federal Reserve trapped between inflation and a slowing economy. A little glitch. That is what the administration is calling the fastest oil price surge in 40 years. Here is what the data actually says. On Truth Social, Trump went further. His exact words, short-term oil prices, which will drop rapidly when the destruction of the Iran nuclear threat is over, is a very small price to pay for USA and world safety and peace. Only fools would think differently. Short-term, very small price, drops rapidly. 3 specific claims, all 3 testable against verified data. That is what this video does. Tests each claim, shows you what independent economists and institutional research actually say, and then tells you what it means for your money, your bills, and your household budget right now. By the end, you will know whether any of those 3 claims hold up. No panic, no politics, just verified facts and honest analysis. CTA. If you want fact-checked financial analysis every week without the spin, subscribe right now. Every video on this channel is fully sourced. Links are in the description. Claim 1, short-term. Let's start with the first claim. The disruption is short-term. To evaluate that, we need to understand what is actually causing it and how long those causes typically take to resolve. The immediate cause is the Strait of Hormuz disruption. Since the U.S.-Israeli strikes on February 28th, Iranian forces have been targeting tanker traffic through the strait. The numbers are stark. According to shipping data compiled by maritime analysts this week, transits through the Strait of Hormuz dropped 95% in the first 9 days of March. Just 55 transits were recorded between March 1st and March 9th. The week before the conflict began, that same corridor processed 160 transits. That is a 95% reduction in traffic through a waterway that carries 20% of the world's oil supply. Not a disruption, a near-complete shutdown of the world's most critical energy corridor. And here is why it cannot resolve quickly. Oil market analysts who specialize in supply disruptions have been very specific about the timeline. Even if a ceasefire were signed tomorrow, even if hostilities ended tonight, it would take approximately 2 weeks for maritime traffic to return to normal. Ships need to be rerouted, insurance underwriters need to reassess, captains need confirmation of safety before navigating a corridor where vessels have been attacked. Beyond traffic restoration, restoring actual oil production to pre-conflict levels takes approximately 2 months. Qatar's LNG facilities have sustained damage. Iraqi production has been disrupted. Saudi facilities face drone attack waves. Physical energy infrastructure cannot be switched back on overnight. 2 weeks for shipping, 2 months for production. That is the minimum timeline, assuming de-escalation begins immediately. It has not begun. But the timeline question goes deeper than oil infrastructure. When oil prices rise sharply, the inflation they generate does not immediately disappear when prices fall. This is one of the most consistently documented patterns in economic history, the oil price asymmetry effect. Here is how it works. When oil rises, businesses raise prices quickly to protect margins. When oil falls, they lower prices slowly, if at all. Airlines raise ticket prices within days of a spike. They reduce them months later, only if competitive pressure forces them. The same dynamic applies to shipping costs, food distribution, manufacturing, and utilities. Goldman Sachs analysis released this week projects that even in a de-escalation scenario, elevated inflation persists 6 to 9 months after oil prices normalize. The Consumer Price Index does not track oil in real time. It lags on the way up and on the way down. Even when oil prices eventually fall, the inflation they generated will stay in your grocery bill for 6 to 9 months afterward. That is the economic research, not speculation. There is also a structural dimension. The person now in charge of Iran, Moshaba Kameh, confirmed as supreme leader on March 8th, was chosen, in the words of an Assembly of Experts member, because even America feared him. He has no incentive to rapidly de-escalate in his first days of consolidated power. Every week, he holds, the strait generates internal political capital. Every week of high oil prices hurts the American economy. Understanding his incentive structure is not geopolitical opinion, it is basic strategic analysis. So on claim 1, is this short term? The minimum realistic timeline for oil supply. Normalization is 2 months. The inflation generated by the current spike will persist in consumer prices for 6 to 9 months beyond that. And the political conditions for rapid de-escalation have not been established. Short term is not the phrase that matches the verified data, CTA. If this kind of analysis is useful to you, hit the like button right now. It helps this video reach people who need fact-based financial information. Takes 2 seconds. Claim 2, a very small price. The second claim, the disruption is a very small price to pay. Let's put an actual dollar figure on that. The oil cost. Before the Iran conflict, West Texas Intermediate crude was trading around $60 to $65 per barrel. As of this week, Brent crude briefly touched $120 and has settled above $110, an increase of approximately 65 to 70% from pre-conflict levels. Goldman Sachs calculates that every 10% increase in oil prices adds approximately 0.2% to U.S. consumer price inflation within 3 to 6 months. A 65% oil price increase translates to approximately 1.3 additional percentage points of inflation. U.S. inflation before the conflict was running at 2.4%. Add 1.3 points, and you're approaching 4%, double the Federal Reserve's 2% target. The Yale Budget Lab calculated that for every 1 percentage point of additional inflation, the average American household loses approximately $900 in annual purchasing power. At one point, 3 additional points, that is approximately $1,170 per household per year, on top of existing costs from tariffs. $1,170 per household per year from oil alone, stacked on top of $3,800 from tariffs. The math of a very small price is adding up to something much larger. The war cost. The Iran military operation itself is not free. The Center for Strategic and International Studies estimated the first 100 hours of Operation Epic Fury cost approximately $3.7 billion. The Center for American Progress, using Department of Defense spending rates for comparable operations, estimates the daily ongoing cost at approximately $1 billion. As of March 9th, 11 days in, the direct military cost is estimated at approximately $11 billion and rising. 3 F-15 fighter jets were lost to friendly fire in the first week. Each has a replacement cost of approximately $117 million. Those 3 aircraft represent $351 million in hardware losses before accounting for pilot training costs and broader operational impact. $11 billion in 11 days, $1 billion a day of American taxpayer money for an operation the administration called a very small price, the shipping cost. The 5 largest container shipping firms in the world, including Maersk, the largest, have suspended Persian Gulf operations entirely. They have announced surcharges of $1,500 to $3,500 per container for any cargo routed near the conflict zone. A container holds approximately 2,000 to 3,000 average consumer goods. When shipping costs rise by $3,500 per container, the cost of every item inside that container rises with it. Appliances, electronics, clothing, auto parts. This is before any tariff impact. These are pure war-driven shipping cost increases, stacked on top of an already tariff-driven price environment. 2 separate causes, 1 price tag you pay at every checkout. The hidden choke point, helium and semiconductors. Here is a detail almost no mainstream coverage has mentioned. Qatar produces approximately 40% of the world's helium, not party balloon helium, but industrial-grade helium used in semiconductor manufacturing, MRI machines, and aerospace applications. Qatar's LNG facilities, which produce helium as a byproduct, have sustained damage from the conflict. Semiconductor manufacturers, the companies making chips inside every smartphone, computer, car, and appliance, depend on consistent helium supply for chip fabrication. A sustained disruption in Qatari helium production could create supply bottlenecks in the semiconductor industry within months. You won't see it in your grocery bill. You'll see it 6 to 12 months from now in the price of a new laptop, a new car, or a new washing machine. 40% of the world's industrial helium supply is now disrupted. Nobody's talking about what that does to electronics prices in 6 months. The recession risk. Prediction markets are among the most efficient aggregators of economic expectations that exist. Polymarket showed a recession probability of 24% at the start of March 2026. As of this week, that number has risen to 38%. Kalshi, a regulated prediction market, moved from 22% to 33% in the same period. In a single week, recession odds rose by 11 to 14 percentage points across major prediction markets. Recession odds nearly doubled in 1 week, not in the media, in markets where people are betting real money on what happens next. So, on claim 2, is this a very small price? $1,170 per household per year in additional inflation from oil. $11 billion in direct military spending in 11 days. $3,500 surcharges per shipping container affecting every imported good. A helium supply disruption that will cascade into electronics prices in 6 to 12 months. Recession probability nearly doubled. Very small is not the phrase the data supports. CTA. I research every statistic in these videos before a single word gets written. Subscribe and turn on notifications if you want to see the next analysis the moment it drops. Claim 3. Drops rapidly. The third claim, oil prices will drop rapidly once the Iran nuclear threat is resolved. This is where the analysis gets genuinely complicated. And I want to be fair to both sides because there is a real case for the administration's energy optimism and a real case that it misses critical variables, the optimist case. The United States is, as of 2025, a net exporter of oil and natural gas. This is a genuine structural change from the 1970s when America was heavily import dependent. U.S. shale production has fundamentally altered the country's energy position. When Middle East conflict sends oil prices higher, American oil producers benefit directly. They're selling at elevated prices. That creates incentive and capacity to increase production, which adds supply to global markets and eventually pushes prices lower. Charles Schwab published an analysis this week worth taking seriously. Geopolitical shocks and crises rarely result in major sustained impacts to global economic growth or financial markets. The Ukraine war caused significant energy price spikes. The U.S. economy absorbed those shocks without entering recession. The U.S. survived the Ukraine energy shock without recession. That is a real data point. The three differences that complicate this case. First, the Ukraine war disrupted European energy supply. The Iran conflict is disrupting the Strait of Hormuz, which affects global supply, not regional supply. Saudi Arabia, Iraq, Kuwait, the UAE, and Qatar all export through that strait. This is not Europe's problem. It is the world's problem. Second, the United States may be a net exporter in aggregate terms, but it is not insulated from global oil prices. American refineries process specific grades of crude. When global crude prices rise, the benchmark price for all oil rises with it, including the oil processed by American refineries and sold as gasoline to American drivers. Net exporter status does not create a price firewall for American consumers. Third, this disruption is landing on an economy already under stress. The U.S. entered this crisis with unemployment rising to 4.4%, job losses in February, tariff-driven inflation already elevated, and consumer confidence already negative. 72% of Americans viewed the economy unfavorably before the first strike was launched. The geopolitical shocks of the 1980s and 90s hit economies in very different starting conditions. Net exporter does not mean price immune, and the shock is landing on an economy that was already weakened before the conflict began. The OPEC variable nobody is discussing. OPEC has significant spare production capacity. It has been holding back for years to maintain price stability. Saudi Arabia alone has an estimated 2 to 3 million barrels per day it could theoretically bring online. But here's the problem. OPEC's spare capacity is primarily located in the very Gulf region currently under threat. Saudi Arabian facilities were themselves targeted by drone attacks during the conflict. Bringing additional production online from facilities under active threat is operationally and politically complicated, and OPEC members benefit financially from high oil prices. Their incentive to immediately cap a price spike, especially one not of their making, is not as strong as the optimist case assumes. OPEC could help lower prices, their spare capacity sits in the exact region currently under attack, and higher prices benefit them financially. Do not assume they will rush to help, what history actually shows. The historical record on oil price spikes following Middle East conflicts is informative but not definitive. The 1973 Arab oil embargo sent prices up 300% and contributed to years of stagflation. Recovery took approximately 5 years. The 1990 Gulf War produced a sharp spike that resolved within 6 months when Saudi production compensated and the conflict ended quickly. The 2003 Iraq invasion caused price spikes absorbed within a year. What distinguishes fast recoveries from slow ones in the historical record is primarily one factor: how quickly alternative supply came online to replace the disrupted supply. In 1990, Saudi Arabia compensated rapidly. In 1973, there was no ready alternative. Today, the disrupted supply is from the entire Persian Gulf region simultaneously. The alternative supply, American shale, Canadian oil sands, takes months to ramp meaningfully, not days. History shows oil spikes can resolve quickly when alternative supply exists and is ready. Right now, alternative supply takes months to ramp, not the rapid timeline being promised, CTA. We just covered the 3 claims and what the verified data shows about each one. If you found this valuable, share this video with one person trying to understand what is happening to the economy right now. 1 share, 5 seconds. Why are markets reacting this way? Now, let me answer the specific question in this video's title. Why are global markets reacting the way they are? Because understanding the reaction is different from understanding the underlying event, and the market reaction contains information that political messaging does not. Markets are not panicking. They are doing something more disciplined and more revealing than panicking. Here is what they are actually saying. Markets react to 2 things: new information and revised expectations. When new information arrives, prices adjust to reflect updated probabilities. This is not emotion. This is mathematics, what the stock market is telling us. The S&P 500 has declined approximately 7% from its recent highs since the conflict began, $3.2 trillion in lost market capitalization. But here is a detail that deserves more attention. Global markets outside the United States have performed very differently. While the S&P 500 has been essentially flat to slightly negative for 2026, international developed markets, Europe, Japan, Australia, have advanced approximately 10% over the same period. The last time U.S. stocks underperformed global markets by this magnitude was approximately 30 years ago. What does this tell us? Investors globally are not generically risk-averse right now. They are specifically reassessing the risk profile of U.S. assets relative to non-U.S. alternatives. The world is not selling everything. It is selling American assets specifically. That is a signal about confidence in U.S. economic policy, not just a reaction to oil prices, what the bond market is telling us. Treasury bond yields, the interest rates the U.S. government pays to borrow, have risen sharply this week. That rise tells us bond markets are pricing in sustained inflation, not the rapid price normalization the administration is projecting. Rising yields cascade through the entire economy. Every mortgage rate is tied to Treasury yields. Every corporate borrowing rate is tied to Treasury yields. When yields rise, mortgages become more expensive, business loans become more expensive, credit card rates rise, the cost of financing anything increases, oil rises, bond yields rise, mortgage rates rise, business loans cost more, your credit card rate inches up. It is all connected, and it all starts in the Strait of Hormuz. What the CAPE ratio is telling us, the cyclically adjusted price-to-earnings ratio, developed by Nobel Prize-winning economist Robert Shiller, has one of the longest and most consistent track records of any valuation tool in finance. In January 2026, the CAPE ratio stood at 40.2. Historically, when the CAPE ratio exceeds 40, the research shows the following average outcomes. Stocks decline approximately 3% within 1 year, approximately 19% within 2 years, and approximately 30% within 3 years. These are averages, not predictions. Individual outcomes vary widely. But the statistical relationship between high CAPE ratios and subsequent below-average returns is one of the most robust findings in a century of market data. The Iran conflict did not cause the CAPE ratio to be 40.2. That valuation was built up over years of low interest rates and strong earnings growth, but it means the market entered this crisis with less cushion than historical averages would suggest it should have. The market was already at its second highest valuation in 150 years before the conflict began. Now add an oil shock on top. That combination is what has professional investors genuinely cautious, what the dollar is telling us. In traditional risk-off environments, money flows into the US dollar and Treasury bonds as safe havens. The dollar strengthens. Treasuries rally. That pattern has not held consistently during the current crisis. The dollar has been mixed, and Treasury bonds have seen rising yields rather than the price rallies typical of safe haven buying. This is an unusual signal. It suggests some investors are questioning the safe haven status of U.S. assets in a way that has not been common in recent decades. The most likely explanation offered by analysts, the combination of tariff-driven trade disruption, fiscal deficit expansion from military spending, and political uncertainty about long-term economic policy is creating a perception that U.S. policy predictability has declined. The dollar is supposed to strengthen when investors get scared. It is not doing that consistently right now. Markets are telling us something about confidence in U.S. policy stability. It is worth listening. CTA. I know this is a lot to absorb. That is exactly why I make these videos, to pull the threads together so you do not have to read 40 separate news articles. Subscribe and turn on the notification bell. It is free. What this means for your money. Now, let me talk directly to you about what any of this actually means for your daily financial life. This section is not for Wall Street. It is for the specific financial decisions you may be facing in the next 30 to 60 days. At the gas pump, current national average, $3.41 per gallon as of Friday. With Brent crude touching $120 briefly and settling above $110, the directional pressure on pump prices is upward. The refinery lag, the time between crude price changes and retail pump price changes, is typically 2 to 4 weeks. The spike in crude happened within the past 10 days. The full impact at American pumps is still working through the supply chain. Practical guidance: if you drive frequently, fill your tank at current prices rather than waiting. If you have been delaying purchasing a more fuel-efficient vehicle, the total cost of ownership calculation has shifted meaningfully in favor of efficiency. Gas prices at the pump are currently below where crude oil prices suggest they should be. The adjustment is coming in the next 2 to 4 weeks. At the grocery store, grocery prices are facing compounding pressures. Tariffs added an estimated $3,800 per year in household costs before the conflict. Oil-driven transportation costs are now adding a second layer. Fertilizer prices, derived from natural gas, which has also risen, add a third layer affecting agricultural production costs. The translation into shelf prices is not immediate. Grocery chains sign supply contracts weeks or months in advance. But by May and June of 2026, analysts project meaningful additional pressure on food prices beyond what tariffs alone were generating. Practical guidance: non-perishable staples, grains, canned goods, dried legumes, cooking oils, purchased now are purchased at today's prices. This is not hoarding. It is rational household procurement management in a rising cost environment. The grocery price increases from oil have not fully hit shelves yet. What you pay today may be less than what you pay in 8 weeks with your job. The February jobs report, 92,000 jobs lost against an expectation of 59,000 gained, was already concerning before the oil shock was layered on top. Oil shocks historically increase recession risk and decrease employment growth. The sectors most exposed to combined tariff pressure and oil shock pressure are manufacturing, transportation and logistics, retail trade, construction, and hospitality. If your income comes from any of these sectors, the risk of unexpected income disruption has risen, not to a certainty, but to a level worth actively preparing for. Practical guidance: if your emergency fund is below 3 months of essential expenses, this is the environment it was designed for. Prioritizing that buffer above other savings goals is financially rational right now. The jobs market was already weakening before the oil shock. 2 compounding pressures on an economy already decelerating is a combination worth preparing for. Not panicking about, but preparing for. With your investments, the most important thing I can tell you, and I will say this as plainly as I can, is that the worst financial decision most people make during market uncertainty is reacting emotionally to headlines. Investors who sold their holdings during the Liberation Day crash of April 2025 locked in losses and missed the full recovery to all-time highs by late June. 11 weeks out of the market, the entire recovery gone. If you are more than 15 years from retirement, the current market environment, volatile, uncertain, driven by geopolitical events, is precisely the environment that long-term dollar cost averaging was designed to weather. History supports staying the course. If you are within 10 years of retirement and your portfolio is heavily concentrated in U.S. equities, this is a reasonable moment to have a conversation with a fiduciary financial advisor, someone legally obligated to act in your interest, about whether your current allocation matches your actual risk tolerance and timeline. Do not make a financial decision in the next 30 days based on a single news cycle. That is the advice. It is boring. It is also what the data supports every single time. CTA. One of the most common questions I get is how to find a financial advisor you can actually trust. In the description, I have linked a resource from the National Association of Personal Financial Advisors to help you find fee-only fiduciary advisors in your area. It is free to use. Perspective, what history shows. I want to pause and give you something more valuable than any individual data point. Perspective. Every generation thinks its crisis is unprecedented. Here is what 100 years of economic history actually shows about moments like this one. The American economy has been through oil shocks before. The 1973 embargo, the 1979 Iranian Revolution, the 1990 Gulf War, the 2003 Iraq invasion. Each time, analysts warned of severe long-term economic damage. Each time, the economy adapted, recovered, and eventually grew. Charles Schwab's research team made a point this week that deserves to be taken seriously. Geopolitical shocks and crises rarely result in major sustained impacts to global economic growth or financial markets. History, on balance, supports that statement. The Ukraine war sent European energy prices to extraordinary levels in 2022. Analysts warned of recession across the continent. European economies contracted briefly and then adapted. The U.S. absorbed the inflationary spillover and did not enter recession. This historical record matters. It is not a guarantee that the current situation resolves the same way, but it is evidence that the economy's capacity to adapt is consistently underestimated in moments of crisis. There are also genuine positive structural factors right now. The artificial intelligence sector is generating real, substantial economic activity. The St. Louis Federal Reserve estimated that AI-related investment contributed approximately 40% of U.S. GDP growth in the first half of 2025. That growth driver is operating largely independently of the Middle East situation. U.S. energy production is at historic highs. American corporate balance sheets going into this crisis are generally strong. The corporate debt crisis that amplified the 2008 recession is not present in the same form today. The AI boom is real. U.S. energy production is at historic highs. Corporate balance sheets are generally strong. These are not nothing. They are real buffers against the shock. Serious does not mean catastrophic. Uncertain does not mean hopeless. Both of those things can be true at the same time, and the honest analysis holds both. The 5 signals to watch. You now know what the data shows. Here is how to know what happens next, the specific signals that matter, and why. Signal 1, shipping traffic through the strait. The single most important indicator of whether this situation is improving or worsening is tanker transit data through the Strait of Hormuz. If weekly transits begin recovering from the current level of 55 toward the pre-conflict level of 160, that is de-escalation in action. If they fall further, that signals escalation. This data is available weekly from maritime analytics firms. I will be tracking it in the next video. Signal 2, Federal Reserve communication. The Fed's next scheduled meeting is in late March, but watch for any unscheduled statements or speeches from Fed officials this week. If governors begin explicitly discussing the inflation implications of oil prices, particularly if they signal willingness to hold rates higher for longer, that tells you the central bank is not buying the rapid resolution story either. Watch their words carefully. Signal 3, diplomatic back-channel news. Qatar, Oman, and Turkey have maintained diplomatic relationships with Iran throughout the conflict. Any reporting of back-channel communications, meetings, or shuttle diplomacy is a positive signal. The absence of any such reports by Thursday or Friday of this week would be a concerning indicator that de-escalation is not imminent. Signal 4, Saudi and UAE oil production announcements. If Saudi Arabia and the UAE announce increases in production, essentially offering to compensate markets for the Hormuz disruption, oil prices will begin to moderate even without a ceasefire. Watch for any OPEC Plus statements about production quotas. Silence from OPEC Plus would suggest they are content with current prices, meaning the supply shortfall continues and oil stays elevated. Signal 5, consumer confidence data. The Conference Board releases its Consumer Confidence Index on March 25th, but watch for early regional surveys from Federal Reserve banks this week. If consumer confidence shows further deterioration, particularly in spending intentions in discretionary categories, that is the leading indicator of a consumer-led slowdown that would confirm recession risk. 5 signals, shipping traffic, Fed communication, diplomacy news, OPEC statements, consumer confidence. Watch these, not the daily market noise, to understand where this is actually heading. CTA. I will be publishing a follow-up video next week covering exactly these signals and what they showed. Subscribe right now so that video is waiting for you the moment it drops. Conclusion. Let me bring everything together. Donald Trump called the current economic disruption a little glitch, a very small, short-term price that will drop rapidly. Here is what the verified data shows about each of those 3 claims. On short term, the minimum realistic timeline for oil supply normalization is 2 months, assuming immediate de-escalation, and the conditions for immediate de-escalation have not been established. The inflation generated by this spike will persist in consumer prices for 6 to 9 months beyond oil price normalization. On small price, approximately $1,170 per household per year in additional inflation from oil alone, on top of existing tariff-driven costs. $11 billion in direct military spending in 11 days. $3,500 surcharges per shipping container affecting every imported good. Recession odds nearly doubled on prediction markets in 1 week. On drops, rapidly. Historical oil shocks resolve quickly when alternative supply is immediately available. Current alternative supply, American shale, Canadian production, takes months to ramp. The OPEC Plus members, who could theoretically compensate, are financially benefiting from elevated prices and have limited incentive to rush. Short term does not match the timeline. Small price does not match the numbers. Drops rapidly does not match the supply economics. 3 claims, 3 mismatches with the verified data. And at the same time, I want to be genuinely fair, the American economy has real strengths. AI-driven investment is generating substantial growth. U.S. energy production is at historic highs. Corporate balance sheets are generally sound. History consistently shows that the economy's capacity to adapt to geopolitical shocks is underestimated in the moment. The honest summary is this. This is not a little glitch. The disruption is real, the costs are measurable, the timeline for resolution is longer than official communications suggest. It is also not the end of the world. The American economy has absorbed oil shocks before, adapted to geopolitical crises before, and recovered from market dislocations that felt catastrophic at the time. The path from here runs through the diplomatic decisions made in the next 2 to 4 weeks. It runs through the Federal Reserve's inflation management. It runs through whether OPEC Plus compensates for supply disruption. And it runs through whether the new supreme leader of Iran chooses pragmatic economics over ideological escalation in the first months of his consolidation of power. None of those outcomes are certain. That uncertainty is real, and it is what markets are correctly pricing in. Uncertainty is not panic. It is information. And now you have the information to read it clearly instead of reacting to it emotionally. Your job is not to panic. Your job is to be informed, to be prepared, and to make decisions based on data rather than headlines. You know what the 3 claims were? You know what the data shows about each of them. You know what signals to watch. You know what practical steps are available to you. That is beyond the panic. That is where good decisions get made. CTA. If this video gave you a clearer picture, share it with one person who needs it right now. And if you want this kind of analysis every week, subscribe below. Every video is fully sourced. No panic, no spin, just the data. See you in the next one.